we're going to start with some basic time value money interest problems. And the first one has 3 parts to it. You can invest $50,000 at 8% interest for 8 years. So how much will you have if we're going to count it with simple interest, compounded annually, and compounded semi-annually? So looking at it, the simple calculation is principal times rate times time. So we have principal times rate times time. Our principal is $50,000. We're going to multiply that by a rate of 8%, and it's 8% per year, and our time is 8 years. You need to make sure that your percentage and your time are in the same category, because what in essence, remember, your numerators and denominators will cancel out, and you end up with interest of $40,000. But this is the calculation for interest. That's not what you were asked. You were asked how much will you have. So remember to go back and read the problem carefully, because you end up with a principal of $50,000, interest of $40,000, and you end up having $90,000. And that's part 1. Part 2 is, what if we're going to compound the interest annually? Well, we end up looking at the future value of one table, and that's the amount if we just have one deposit, or we have to calculate it individually if our deposits change each time. But if the deposits are the same and the intervals are the same, we could use the annuity table. But what we end up looking is 8% interest, and for 8 periods, we end up with a factor of 1.85093. This is what our $50,000 is going to rise to. So this includes interest and principal. So if we take $50,000 times 1.85093, we end up with $92,547. That's if we calculate the interest annually. So I'm just going to back up on these numbers a little bit. Because what if we changed our factor? And this is what's going to happen. If it's compounded semi-annually, it's going to be compounded a total of 16 times. So I'm going to have 16 periods. But it's not going to be for 8% each time. It's only going to be for 4%. So when I look up that factor on the future value of $1, I end up with 1.87298. If I take the 50,000, multiply it by that factor, I'm going to end up with a total amount of 93,649. Now, if we compounded annually, that number was only 92,547. So just by compounding it every 6 months instead of every 12 months, we already have an extra $1,000 in interest. Now this problem's kind of the flip side, but I want you to start paying attention to what you're reading. How much would you need to invest now if you wanted to have $20,000 in 7 years? So go back to thinking about a timeline. In 7 years into the future, you wanted this $20,000. Now, how much would you have to invest here? So we want to know the present value because we've got to bring this back. We don't have an interest rate, so let's just throw in 9%. If you look on the present value of one table, for 9% and 7 years, you end up with a factor of 0.54703. If you multiply that by the 20,000 you want, you would need to have $10,940 now. Well, that makes sense because we would turn around and we'd have $10,940 grow at 9% per year to $20,000. So what I want you to do is not pay attention to whether they're telling you future value or present value in the problem. I want you putting it on a timeline so you can see it. because somebody could have said, what if you wanted 20,000 into the future, 7 years into the future? They end up putting the idea of future in your head, and people tend to look at the wrong table. So place it on a timeline and see where that goes. The next question deals with annuities. What would you have if you deposited $5,000 a year for 10 years at 8%? Well, the fact that you're depositing the same amount at consistent intervals is going to make this an annuity. So if we timeline it and you're going to be putting in money, you're going to be putting 5, 5, 5, etc. all the way up for 10 years at this 8%, you want to know how much you're going to have here. So we know we have the 5,000. If we take the annuity amount or the rent payment times the factor for future value of an annuity, we're going to come out with this final amount. The factor, if we look at 5% per year for 10 years at 8% interest, the factor for 10 years at 8% is 14.4866. And if we multiply that by the 5,000 we're depositing, we're going to end up with 72,433. Now, if we switch this out just slightly and we change this to 10 periods, and we say it's going to be compounded semi-annually, you end up getting a number 20 at 4%, and that factor is 29.7781. So if we take our 5,000, multiply it out there, you end up with $148,000, $891. You're basically making twice as many payments over that time period. This is a slightly different problem. What's the value today of the future annuity rents of $5,000 at 5%? So what you end up having is you're going to be getting these rents of 5. In the last problem, we wanted to know how much they were worth at this end. We don't want to do that now. We want to know what they're worth today. So that's the present value. So if we look at the present value of an annuity and we multiply that annuity of the 5,000 times this factor, which is going to be the present value of an annuity at 5%, and let's make this 20 periods, we end up with a factor of 12.64221. Just like in the prior problem, you're going to take your annuity amount or your rent amount times the factor. So we're going to take 5,000 times your annuity of 12.64221, and you end up with a value of $63,211. You want to stop and think about that. We're saying we're going to have this $63,211 here. So $63,211 is going to be deposited in an account. It's going to grow at 5% interest. And in essence, you're going to take out $5,000 every period for 20 periods. And at the end, you're going to be left with nothing. So you're going to end up taking out $5,000 for 20 periods. You're going to end up taking out $100,000. What is that $100,000 worth today? $63,211. So it does make sense. The next set's kind of word problems. Your company has $250,000 of bonds payable due in 10 years. So if you deposit $20,000 per year at 8%, will you have enough? You've got to work on that. So first things I'm going to do is fix this, make it per year. The second thing is we're talking about an annuity. So basically, you already know you're going to owe in your timeline. You're going to owe $250,000. So you want to make these deposits of $20,000 each time. You want to know if that value in the future will help you with this amount. So we don't want to know the amount at the beginning. We don't want to know the present value, but we do want to know the future value. So if we look at a future value of an annuity table, 8% for 10 years, we get a factor of 14.4866. And if we multiply that by the 20,000 that we're going to make as annual annuity deposits, because we're going to take that formula of an annuity times the factor, you're going to find that at the end you're going to end up with $289,732. Please don't stop there. Go back. What's the question? Will you have enough? Yes, you will have more than enough. So here's another decision. You won the lottery, and you have to choose between taking $300,000 in cash now or the $1 million that you won. The catch is the $1 million is paid over the next 40 years in annual payments of $25,000. So if your yield rate or your interest rate is 8%, which is better for you to select? So here's the idea. You know you're going to have $300,000 now, or you're going to have these $25,000 payments. And we need to know which is better. So let's put them on the same terms. Even though these 25,000 payments is going to total $1 million, let's compare apples to apples. What is it worth today? Our baseline is this $300,000. So we need to know the present value of an annuity. The annuities being the $25,000, and the theme here is take your annuity times your factor. So your factor for the present value of an annuity for 40 periods at 8% interest is 11.92461. And if we take your $25,000 that you're going to receive annually, multiply it by the factor, you end up with an amount of $298,115. So your choice is $300,000 now, or what's worth $298,000 now. So in this case, take the money and run. The next problem, it's a medium problem in terms of difficulty, but it's got a bunch of great concepts put together. So given a market rate of 8%, 10%, and 12%, what would be the value of a 10-year 10% bond with a face value of $20,000? There's a couple things going on here. First thing, the value stated on the bond is 10%. That's the stated value. So the stated value, the only time we ever use that is when we're determining the interest payments. So if we're going to have a $20,000 bond, we're going to have interest payments of $2,000 per period. That's all we're going to do with this. The second thing we need to make sure that we understand with the bond is we're going to talk about a couple things. First of all, there's going to be an annuity payment, which is going to be an interest payment. This is the $2,000 in interest that's going to be received. We need to know the present value of an annuity to find out what the value of those interest payments are. Then the second thing is, at the end, there's no payment all along, but at the end, the face value of the $20,000 is going to be paid back to the bondholders. So we need to know that amount. So we've got present value of a dollar. So your bond is a combination of the present value of a dollar for the $20,000 principal payment and the present value of all those annuity payments. The best way to think about these is to set them up, and I'm going to set them up where all the problems can be done the same, and you can see the interest rate And what we're going to do is we're going to look up the different factors. We know we need to have present value of the annuity for the interest payment, and we know we need to have present value of 1 for the principal payment. And we're going to do this for about the 8, the 10, and the 12% interest. So the factors, if we're going to do this, for the 8%, the present value of an annuity is 6.71008. For 10%, it's 6.14457. And for 12%, it's 5.65022. For present value of 1, for the 8%, it's 0.46319. For 10%, it's 0.38554. And for 12%, it's 0.32197. Then we need to figure out what the present value of the interest is. So that would be the $2,000 stated interest rate times the present value of an annuity factor. So for 8%, the present value of that is $13,420. and 16 cents. For 10%, it's $12,289 and 14 cents. And for 12%, it's $11,300 and 44 cents. The present value of the principal, which is the $20,000 face value of the bond times the present value of one figure, for 8% is $9,263.80. For 10%, it's $7,710.80. And for 12%, it's $6,439.40. So the total is the value of the bond. So if we're giving a 8%, the market value is giving 8%, and our bonds are saying 10%, these bonds are actually going to be sold for $22,683. That's a $2,683 premium. And that makes sense because we're giving a better rate than everybody else. So we're going to have customers wanting to come to us. We're going to have too many customers, and why should we give more than everybody else is? So we're going to actually charge more, so that we're going to pay $22,000 for a $20,000 bond, and they're in essence going to get the 8% market rate. If we're giving 10% on our bonds and the value of the bond is 10% and the market value is 10%, we end up with the value of bond $19,999.94. We're 6 cents off of being perfect, probably rounding somewhere. And then if our bond is 10% but the market rate is 12%, we're going to get no customers. Nobody's going to come. So we need to do something to induce people to come. And we're going to lower the price of the bond. And what happens is if we count this out, you end up with $17,739.84. So we're going to give a discount on that bond of $2,200. So people will give us $17,739. They will get annual interest payments of that $2,000, but they'll get the $20,000 when all is said and done. So the effective interest rate is going to be 12% on those, and we call that at a bond discount.